So picture this. A massive financial storm hits the market. Does it turn out that some companies have a kind of built-in life jacket? Well, today we're going to dive into the absolute chaos of the early 2020 market crash to see if ethical investing, what we call ESG, actually helped protect some firms while pretty much everything else was sinking.
Okay, so let's set the scene. It's the very beginning of 2020. This new coronavirus starts spreading, and what begins as a health story quickly, and I mean quickly, spirals into a full-blown financial panic. The markets are completely on edge, just freaking out over every single headline.
And this all happened incredibly fast. Just think about it. Early January, the virus gets identified. A few weeks later, boom, January 23rd, the entire city of Wuhan goes into lockdown. Now, the Chinese stock markets were closed for the Lunar New Year holiday, but the second they reopened on February 3rd, the reaction was immediate and absolutely brutal. Yeah, that reopening just unleashed a tidal wave of selling. You had investors who were completely uncertain about what was coming next, so they rushed to pull their money out, and that sent one of the country's main stock indexes into a total nosedive.
Just look at this number, negative 7.7%. That's how much the CSI 300 index, which tracks 300 of the biggest companies in mainland China, plunged in a single day, the very first day of trading after the break. I mean, to give you some context, that is a massive, massive drop for a major market index. It was a huge warning sign of the economic shock that was coming.
So this brings us to the big question of this whole explainer, right? When basically everything was tanking, did any stocks manage to hold up better than the others? And if they did, what was the secret sauce? What did they have in common? Well, researchers started digging through all the data, and they found this really fascinating pattern. It kind of looked like a company's values, specifically how well it performed on environmental, social, and governance stuff, acted like a financial life jacket. And the pattern was pretty clear. On average, companies that had poor ESG ratings, their stock prices fell way more sharply. But the firms with high ESG ratings, now, they still fell. I mean, let's be real, the whole market was in crisis, but their declines were significantly smaller. They were just more resilient. Okay, so what exactly is this ESG thing we keep talking about? It's an acronym, and it stands for environmental, social, and governance. You can think of it as a way to size up a company not just on its balance sheet, but on its overall character and its impact on the world. So to really get this, we've got to peel back the layers. Let's break down what each of these letters actually represents. What are people actually looking at when they talk about ESG? All right, so the E is for environmental. This looks at a company's footprint on the planet. Stuff like its pollution levels, how it manages resources like water, if it makes green products. Then you have S for social, which is all about relationships. How does it treat its employees, its suppliers, the community? And finally, G is for governance. This is about how the company is actually run. Is the leadership ethical? Are they transparent? Is the board independent and diverse? Okay, so that's the theory. But what's the actual proof? What did the data in the study show? Did these things really make a difference when the market was in an absolute freefall? What's really interesting is that even before the crisis, these high ESG firms were already doing better. If you look back at a portfolio of high ESG companies, it was consistently outperforming a low ESG one. Between mid-2017 and the end of 2019, that high ESG portfolio delivered a return that was nearly 13% higher. And this quote from the researchers themselves really gets right to the heart of it. This isn't just a hunch. The data showed a direct, statistically significant link. A higher ESG score meant more resilience during that crash. In other words, that life jacket effect, it was very, very real. But, and this is where the story gets really interesting, when the researchers broke ESG down into its three parts, they found something kind of weird, something they didn't expect. Turns out, not all the letters in ESG were created equal during the crisis. And this table lays it all out perfectly. As you can see, doing well on E for environmental and G for governance was a big plus for company stock. Investors saw good environmental practices as a sign of an efficient company, and they saw good governance as a sign of stability. But then you get to the S for social, and whoa, this is the twist. A high S score was actually linked to worse returns. The theory here is that the most socially responsible companies felt more pressure to keep paying their employees, even during a shutdown, which of course hurt their short-term profits.
So all of this leads to the final, and maybe most important, takeaway from this research. It's not just that ESG matters, but when it seems to matter most to the people putting money into the market. The paper uses this great analogy. Think of it like an insurance policy. In normal, calm market conditions, investing in these high ESG companies might mean you get slightly lower returns. You're basically paying a small premium for that extra safety. But when a crisis hits, when panic is in the air, that's when that insurance policy really pays off. The value of being a well-run, responsible company suddenly becomes crystal clear to investors who are desperately searching for a safe place to park their cash. So here's the crucial point. The role of ESG wasn't static. The researchers found that its importance was way stronger during the crisis. In normal times, sure, it was a factor. But during the panic of early 2020, it became this incredibly powerful signal of which companies could weather the storm. So, what's the big takeaway from all this? Well, first off, a company's ESG score isn't just some feel-good metric. It can be a real signal of how resilient that company is. Second, when the markets go haywire, it seems like investors run towards what they see as quality. And this research suggests ESG is a big part of how they define quality. For anyone investing, this could be a really powerful tool for managing risk. Which leaves us with one final, pretty important question. In a world that seems to be throwing more and more unexpected crises our way, could a company's commitment to the planet, to its people, and to ethical leadership actually be the best new indicator of its strength to survive the next storm?